morning, everyone. I wanted to get together with you, and Pam and I are in the middle of tax season. So we thought it might be helpful to talk about some of the common problems with tax filing that we encounter, because we issue a lot of tax receipts, so we get a lot of call from our clients on their tax returns and questions about their tax receipts. So we do send you out a communication early in the process to kind of give you an idea of what dates you can expect different things to be mailed. And in addition to that, our firm sends out mid-March a communication that's called a tax list checklist. And what it does is give you what receipts you can expect to receive from us and from some of the mutual fund companies that you have in your non-registered accounts. So we find the most common error is not waiting for all your receipts before you file. Unfortunately, for those of you that have non-registered accounts, and some of them are fairly large, you do get income during the year, different kinds of income. You sometimes do sales of assets during the year, which you are required to report gains or losses on. And so many of the receipts do not come out early in the year the way that your registered plans do. They tend to come out later in the year. A lot of them March, towards the end of March. Some of the T3s come out towards the end of March. And if you've had an investment which has resulted in a return of capital adjustment, which a lot of the REITs and a lot of the iShare ETFs have return of capital adjustments, those can't occur until they have their March 31st calculations. So those don't occur in our system until the first week of April. So for some people, that filing of the realized gains and losses needs to wait until after those return of capital adjustments. So the precaution that we would give you is don't be in a big rush. If you feel you might have a return of capital adjustment, or we've let you know that you might have a return of capital adjustment, you can give all your other receipts to your accountant. Just let them know not to file until you've given them those last adjusted cost bases. We do have a list here of people that will have return of capital adjustments. So if you feel like you haven't received your communication about your realized gains early enough, maybe you give us a call and we will let you know if you're subject to return of capital adjustment and get that out to you in April as early as we can. So I'll turn it over to Pam, our CPA on call. And Pam's going to talk to you about some of the other things that you should watch for as far as your tax return, things like missed deductions and common errors that we see on tax returns.
Exactly. So once you are ready to file, once you have all your slips, there's just some things we wanted to make sure that you keep in mind. A lot of people can forget about them or sometimes not even know, and we do a lot of tax return reviews as well to make sure that our clients are claiming all these. And so these are some of the common ones that we've seen missed in the past, starting with investment fee deductions. So your investment fees that you pay on your non-registered investment accounts are actually tax deductible. So in the middle of March, when you get your tax slip checklist, you'll also get a fee summary that'll outline what you paid in fees to your non-registered or registered investment accounts. Anything paid to a non-registered account is actually a tax deduction that's going to lower your overall tax bill. The second is charitable donations. A lot of people make donations throughout the year. It's really important that you keep track of all your receipts. Some people will do in-kind donations that can be facilitated through us. So an in-kind donation is a donation of a share where you're actually going to be missing the capital gain on it. So it's a double benefit. You get the tax deduction for it. You're not going to be triggering capital gains from that amount in the future. And that's something that we're able to assist getting those receipts for you. But anything, especially if it's not through us, making sure that you collect all your receipts throughout the year to make sure you're getting all of those deductions, because they're really beneficial. Next is couples missing eligible pension splitting. So if you're over the age of 65 and have RIFs or lifts, or under the age of 65 but have eligible pension income, you can actually do what's called pension splitting with your spouse or common law partner. And what this is, it allows you to move some of the income, maybe from the higher earning spouse over to a lower earning spouse that may be in a lower tax bracket. So it's saving you a bit of money there. Also lets you to hopefully lets you stay under the OAS clawback threshold. So the clawback threshold for 2025 was 93,454. Maybe you might be eligible to do pension splitting and help keep you under that if you're a high income retired individual.
That's increased a little bit this year. It's 95,000 this year.
Goes up a little bit every year.
They give us a little bit more room every year.
Exactly. And the last thing, a big one that people don't even think that they may be eligible is the disability tax credit. So if you, your partner, or a child has a disability, you may be eligible for this credit that can actually be retroactive. So if your doctor says that you've actually had this disability for a number of years, you can retroactively refile your tax returns and get refunds for previous years. Some people don't even think that they may be eligible, but there's things like certain types of diabetes. With certain types of diabetes, you may be eligible for this and may be able to claim this moving forward. So it's really important to look into this, know what it is, and see if you qualify, because it's a big one that's missed for a lot of individuals.
Yeah. One of the things that I'd like to mention too, other than the filing deadline, which is April 30th, except for sole proprietorships, is if you're doing your own tax return, be aware. For example, you're using the pension splitting calculator, and you're in a fairly high income with your pension and your different RIFs and lift income. Be careful when you're using these things and doing your own, because you need to know those tax OAS clawback rates. I've had one client one year who thought he'd saved a bunch of tax money using that calculator. Unfortunately, the way he split their income, he lost his OAS, most of his OAS for the year, because that pension calculator in most of the tax software programs does not take OAS clawback into account. It only tries to save you tax. So just watch that 95,323, which is of net income, not gross, net income, which is where the government will start pulling back your OAS. The other thing that I do stipulate is if you've had an unusual year, if you're used to doing your own tax return, but you've had an unusual year, you've had a sale of a property, you've had perhaps a death and you're working on some estate returns and final returns. Maybe your company has been sold and you've had a disposition of stock, which is unusual and might need to be reported differently. Get professional advice, pay a little bit of money and get professional advice, because it's much easier to do that at the beginning when you're in a complex tax situation than try to fix the problems that arise from filing incorrectly, or maybe tax that you pay that you didn't need to pay because it wasn't filed correctly. So that's the only cautionary tale that I would say. We see it here, and going back and trying to fix it after the fact is work. So I think that's it for today. Hopefully you found some of this information helpful, and good luck on filing your 2025 tax returns.
I like